Welcome back, and once again, this video links to a Substack article that I wrote. So we'll put the link to that in the description. Please feel free to check it out. Don't forget to subscribe as well if you want to read the latest Substack articles as they come out. So if I said to you that after the 1929 stock market crash, there was a spike in suicides in the US, in particular in New York, I think most people watching this right now would agree with that. It's become an accepted fact that, because of the magnitude of that 1929 crash, there was a significant increase in the number of suicides. And we've probably all seen photographs of, people standing on window ledges, apparently about to jump out of windows, and those sorts of quite, terrifying images. And it has become an accepted fact that there was a jump in suicides after that 1929 stock market crash in October. Unfortunately, it's not true. And Robert Schuller points this out in his book, Irrational Exuberance. And the reason why he points that out and other examples of this is because he wants to point out that the public can learn what he calls false facts. So in this case, I think it's widely accepted that that's what happened. And it's plausible. Here's the thing. It's plausible that after such a horrific event like the stock market crash, that, people saw their savings wiped out, in some cases, perhaps on margin loans, etc., or similar loss, more than they could, that people, might commit such a horrific act as committing suicide. So it sounds plausible, and therefore people just accept it. But it's not true. And this happens all the time. There are numerous facts or accepted wisdom. Now, when I researched my book about technical analysis, which, the republished version, Technical Analysis Exposed, I found numerous examples of this. Statements which have been accepted as fact by technical analysts, which are simply not true. And they include things like the reliability of the Head and Shoulders pattern, well regarded by technical analysts as a very reliable pattern, yet independent studies have shown that it's a toss of a coin, 50-50. But in this, I want to show how in real time we're seeing this happen. How in real time, because if a few people, particularly if they have a big following in the modern era with social media, how certain ideas can become accepted wisdom, and this is happening right in front of us lifetime now, even though they're not valid, even though they're in some cases completely false. So the example I'm giving, I'm coming back to this gamma analysis, which is becoming so popular. So we recently, as I write this, we just had the expiry of the June quarterly JP Morgan collar trade, which has become something that at any volatility and gamma account has to reference at least, a few times every quarter to make themselves appear relevant in the world. And one of the areas that they focus on is areas of the largest open interest. And the gamma accounts, in this case, in the JP Morgan, the last quarterly expiry, the 43.20 strike was one of the strikes involved, and it was around about at the money, just slightly in the money, but around about at the money. And the gamma accounts talk about this in terms of the gamma effect of this. And almost everybody out there who's talking about gamma or volatility in some way, of the ones that are really aiming at retail traders, will talk about these large open interest strikes in terms of the gamma on them and the dealer gamma. The dealers, in this case, with the 43.20 calls that were expiring in June, the JP Morgan fund had sold these to the dealers, to the market makers. And so the widely accepted view was that the dealers, the market makers, are really heavily long this strike. This is, a big strike, and therefore they were going to compress the underlying market, the volatility, and potentially the market would get pinned around there. There's a number of things to unpack there that just simply don't make much sense. And I want to talk about this idea. So this trade was first put on 3 months ago. At the end of the March expiry, when the March trade went off, JP Morgan rolled into the June. So the reason why the open interest 3 months later remains very high is because JP Morgan hold the trade till expiry. Therefore, the open interest is going to remain high. Unless they exit the trade, the open interest will remain high. But that doesn't mean that the dealers, the market makers, still have the same exposure to that strike, and it doesn't mean that the gamma effects are going to remain that high, and I'll explain why both of those. So firstly, the market makers, the dealers, they've had 3 months to exit the strike risk associated with that trade. In the general course of their market making, they're going to be buying and selling these options, hundreds, thousands of times over 3 months. So they have numerous ways in just to trade out of the actual options themselves that they traded with JP Morgan. The second point is they can exit some of that risk through weekly options, monthly options, even daily options. So they have a number of other ways of exiting that risk. The third interesting point about these 4320 strike in particular was when the trade is first established 3 months ago, the 4320 strike was a deep out of the money, or reasonably deep out of the money calls. Okay, so in that sense, they are trading as deep or as out of the money calls. The puts associated with that strike, the 4320 puts, are going to hardly trade. They're deep in the money. They're hardly going to trade. Now, some of the gamma accounts have in part of their assumptions the assumption that all out-of-the-money calls are sold to the dealers, all of them. Now, again, I won't subscribe to that assumption, okay? I don't believe that's true. I believe that some of them, maybe a higher percentage will be, but certainly not all of them in my opinion. But some of the gamma accounts will tell you that you have to assume that all out-of-the-money call options are sold to dealers and all out-of-the-money put options are bought from the dealers. Therefore, the dealers end up long of out-of-the-money call strikes and short of out-of-the-money put strikes. That's how they claim. Now, this 4320 strike was an out-of-the-money call option when the trade was first established. But during the 3 months the trade was open, the underlying index, the S&P 500 index, SPX, underlying index rallied. At some point, the 4320 calls became at the money. Now, that dramatically changes the demand and supply dynamics for that strike. And even by those gamma accounts' own admissions, they're no longer just going to be it's no longer just going to be a strike that the dealers, that the market makers are only going to buy. Now it's an at-the-money strike, and there's usually more two-way business on at-the-money strikes. The other thing with it being an at-the-money strike that it opens up is that there's now going to be a lot more trading in the 4320 put options, and that's what happened. The open interest on the put options, started to increase as well. It didn't get to the level of the calls, of course, because there was no such huge JP Morgan fund trade behind it, but it was still grew to, I think, over 20,000 puts. So now the puts are trading, and that is significant because as a market maker of options, if I buy the calls of one strike and hedge them delta neutral, which all market makers do, and I can sell the puts of the same strike and hedge them delta neutral, they effectively cancel each other out. They have the same gamma, the same vega, the same theta. The only difference between 4320 calls and puts is one has a negative delta, one has a positive delta. So once you hedge out the delta, they're pretty much exactly the same. It does leave you with something called pin risk, which I won't go into here, but market makers are usually accept or comfortable with trying to manage pin risk. But the point is, this is another way that the market makers can exit their strike risk associated with 4320 calls. They could sell some puts as well of the same strike. Interestingly, the underlying market then went up even further, and the 4320 calls then became in the money calls, which meant the 4320 puts now become out of the money puts, which according to the gamma accounts are always bought by end clients, always sold by the market makers. So the dynamic of that strike has changed considerably over the 3 months. The opportunities for the market makers to exit that strike risk are huge, and they almost certainly would have exited, if not all of the strike risk, then most of it. If they wanted to be out of it, they had plenty of opportunities. And what's interesting is that the gamma and volatility accounts that you see out there are still telling you that because the open interest of that strike was huge, that the dealer exposure was huge, that nothing had changed. Their view was nothing had changed. This has become accepted wisdom in a huge part of the option and volatility space, but it's simply not true. The other important point to make is this, that in terms of the reason why they're analyzing these strikes and this open interest is because of that dealer gamma effect that they're telling you about, okay? The view is that if dealers are long lots of gamma, then that could suppress volatility. And if, for example, with out of the money strikes put on the put side, if there's short lots of gamma and there was a move, they would exacerbate that move. The point about this as well is that only traders who are hedge delta neutral are worried about the changes in gamma, or the change in delta that's associated with gamma. Okay, and I don't want to get too complicated here. If you want to learn more about options, I do have my options, learnoptions.net, and there's a free course on there. But to sort of simplify this, realistically, the vast majority of traders in the options market don't re-hedge gamma. Okay, they don't hedge their trades delta neutral, therefore they don't need to re-hedge. Why is this important? Because the market makers, the dealers, as they are exiting the strike risk over the 3 months of, this, for example, the 43.20 strike, the people they're selling these options to, most of them are not hedging delta neutral. Therefore, the gamma effect is going to be greatly reduced because the people owning those options are not re-hedging due to gamma changes. So you can see how I've tried to break this down in numerous different ways to explain how and why this analysis is incorrect. Yet it has in front of our eyes over the last particularly 12, 18 months, it's become accepted wisdom. If you look at most vol and gamma accounts, they will analyze that trade in terms of its gamma 3 months after the original trade was put on. They make no mention of the fact that it's going to have changed significantly. This is how things can become accepted. Now, lots of traders out there, retail option traders, retail futures and equity traders are taking this on board and are thinking about that. There were predictions made that the underlying S&P wouldn't be able to get away from that strike and all sorts of things like that. As happened, it did. It moved higher, and there was really no effect from that 43.20 strike in the run-up to expiry. That's common. And what you saw was those accounts just quietly just sort of forget that they'd ever mentioned anything about it, okay? But the next time they'll make the same thing. And what happens is sometimes, you know, they will be seen to be right because the market may have stayed there, and they'll say, see, I told you so. But it has nothing to do with their analysis. It's just what happened to happen on that occasion, okay? But the point is the analysis is incorrect, yet has been accepted as now as, well, that's what it is. Because these people are the people that everybody looks at. They are the self-proclaimed experts. So I think it's fascinating to see, you know, I Lifetime didn't really see the take-up of the technical analysis fallacies that became accepted, but I'm seeing this Lifetime now with some of this gamma analysis, and I find that fascinating. So it's a topic that all traders need to understand, because some things that people will tell you that you think are accepted as fact, like the suicides after 1929, are just simply incorrect. So I hope you enjoyed this. Like I say, if you're interested in learning more about options, I have a free course at learnoptions.net. Otherwise, look forward to seeing you next time.